Sense out of all of life's decisions involving your dollars. We've got a special show for you this morning. We are pleased to introduce our newest certified financial fiduciary at Nelson Financial Planning, Zach Keister. Welcome to the program.
Thanks for having me, Joel. Very happy to be here. Good to call it the inaugural show, I guess.
There you go.
I guess that means I'll get more than one shot.
Well, I guess. Yes, we'll do that. Yeah, we're not going to wait for the jury to come back. We'll give you. We'll continue to give you some airtime on the program because that is part of your background. Interestingly enough, you've got a background in radio. So why don't you share with the listeners about that and the rest of your background?
Luckily enough, grew up in the radio industry as a kid. Thoroughly enjoyed it. My grandfather ran some radio stations and grew up in it every day, every week, every weekend. Two main advantages to that. I knew what the school lunch menu was, and I knew when school was going to be closed before anybody else. So you can imagine my phone blowing up constantly of folks saying, is school going to be closed? What, are we having hamburgers or are we having hot dogs for Tuesday lunch? What's it going to be?
That is good stuff. Now, obviously, from that introduction as part of the family, if you will, in radio, you then proceeded on with a different career path before you came to us at Nelson Financial.
A little bit
Planning.
different in a career path, yeah, Joel. Spent some time, about 8 years as a fireman in Central Indiana. Thoroughly enjoyed that. Learned a lot. Learned a whole bunch of stuff from those guys on various crews because they all worked other jobs as well. So some carpentry, some electrical stuff, and that kind of stuff. So
yeah, you have become, I guess, the resident handyman when we're in a pinch at the office. So we certainly appreciate those skills that you're able to bring to the table.
Yeah, absolutely happy to help out any way I can to enjoy.
So let me see here if my memory serves me correct. So you have been with us at Nelson Financial Planning for, is it 4 years now?
3.
3 years.
Yeah,
okay, so coming up on 3. So you're perfectly on track for what we like to call our program, if you will, where you start out, you learn about the industry. After 3 years of sort of being involved in helping us with client matters, then you ultimately sort of become a certified financial fiduciary where you're able to kind of do more direct financial planning with our clients. So congratulations on achieving that accolade. Over the past 3 years, what have you been kind of focusing on at the office?
Myriad of items, thoroughly enjoying all of it. Investing in general, learning about the industry, all that stuff is very interesting. Different numbers, different facts, different variations of forms of investments as well. A lot out there. Do a lot with the folks of FRS as far as allocations and that kind of stuff, of which I think we're going to hit on pretty heavily. For too long.
Correct. That's going to be one of our many topics that we'll talk about on this week's program. But yeah, so your background sort of in public safety obviously matches up well with the folks that are police or sheriff or fire department folks within the Florida retirement system. We've certainly worked with a lot of folks to help them successfully retire. And then, of course, you also helped on the book last year, Next Gen Dollars and Cents. What were some of your chapters that you helped research and complete for us?
Budgeting, retirement budgeting, planning, investing, that sort of stuff. Really enjoyed it. A lot of good topics in that book, and we're going to make some points as well straight out of the book.
That's very good. So now, before we get to that, we're going to, I guess, take a 15-second moment to brag about Nelson Financial Planning. What's the big news that we're going to share this morning, Zach?
Joel, and this personally is very exciting for me. Being able to work in such an environment that has been voted one of the best places to work
by the Orlando Business Journal. Yes. So it was the first time we ever really even bothered to kind of engage in that in that discussion, and we said, well, yeah, why not? Let's engage in it. So happy to have been named by the Orlando Business Journal as one of the best places to work. As I like to say, what makes us a best place to work is we really do have the best people, Zach.
We do.
We do.
I'd have to agree with that.
Indeed. So
the best personalities.
Well, there you go. We like that. We like that too. That's for sure. So Zach, working off your public safety background, you spent a lot of time, as we said, working with the folks in the Florida retirement system, helping them to retire successfully. So, what's the issue that we're going to help us frame the issue of what we're going to talk a little bit about today?
So, a lot of pension plans have recently divvied down this road of private equity. And a lot of folks don't understand it. It's a little complex when you're not, versed in the different investing options and that sort of stuff. And so a lot of folks in the FRS and those kinds of pension plans just kind of go along with it because it sounds cool. It sounds great. It's this, kind of deal of like, oh, I've got this very cool, sophisticated investment. And, as we're going to dive into, you might not be so keen on it.
Yeah, you might be very surprised. And what's interesting is that state pensions, and we don't mean to be picking on the Florida retirement system pension plan because this is consistent across the board.
Yeah.
A lot of pensions have kind of really decided to jump into this private equity arena. And I think if you look at pensions as a whole, about nearly 1/6 of the assets in a pension plan. So whether it's the state of Florida's, the state of California's, state of Illinois', whatever the case may be, they've got a pretty good exposure to this private equity. And you folks need to understand that there's a lot of hidden fees and hidden costs behind it.
Yeah, between the high illiquidity and the lockup periods and that sort of stuff. And to look at that 1/6 number, that breaks down to the average investor being at 17% invested into this product.
Well, that is true because what we're also seeing, unfortunately, is not just pension plans that are loading up on sort of these illiquid, high-cost investments, but we're now seeing it getting pushed over to individual investors, and that then becomes a situation that can certainly hit home for a lot of investors. So we're going to talk at length about sort of what private equity is and what you need to know in order to identify it or make sure it's not identified inside your portfolio. And then to talk a little bit more about these issues involving these pension plans. It's pretty dramatic how much this private equity stuff, particularly with the current environment that is higher interest rates, and the management fees on these private equity things have always been huge, but that's a bad combination.
Absolutely. And then also the fact of how far they're having to go to then pay out of these pensions. When you think about your pension, it's like, okay, this is my normal monthly income. And it's like, okay, these folks are having to make some very drastic measures to get me my money that I need on a monthly basis.
In fact, the state of California has for 8 years in a row actually had to pay out more into private equity than what it has gotten. So that is not a good situation. And later in the program, we're going to give you those exact statistics that relate to the state of Florida pension plan and what its experience of late has been within private equity. And those numbers are absolutely going to shock you. I know when we talked about them this morning, it was just unbelievable.
We both say unbelievable at the same time. That's how unbelievable it is.
Goodness. But the sad reality is that it's also proliferating into individual investors as well. So folks really need to be careful with this stuff. And then, Zach, you're going to also share just how important it is to start investing early and how important that is.
Yeah, absolutely. We're going to cover that as well. All coming up soon.
And the power of compounding also works amazingly when you start early as well. So with that, we're going to take a break and return after these messages. This is Dollars and Cents with Joel Garris and Zach Keister of Nelson Financial Planning, both of us certified financial fiduciaries, here to help you make sense out of all of life's decisions. Make sure you check out our website at nelsonfinancialplanning.com to learn. So private equity investments have just had a ton of money pouring into them of late. And in particular, a lot of pension plans across this country have really loaded up on these private equity investments with sort of the allure of, oh, we're going to get a better return. But Zach, in the environment that we've got now, my goodness, with higher interest rates, incredibly costly management fees, a lot of these are showing that it's probably turning into not as good as a deal as people thought.
Yeah, that's right. Just as we were talking a minute ago, the rate at which they're having to run at a clip to pay out is just enormous, and then the factors in which they're having to do to get there is just
and with the average being nearly 1/6 of all assets and pension plans in these investments, we certainly thought it would be a good topic for this week's program, particularly Zach, with you joining us on your first of many radio programs with us at Nelson Financial Planning. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. You can check us out on your favorite podcast or social media platform. Any trouble finding us on those channels, go to our website, Nelson Financial Planning, and there you can find us most easily. Once there, subscribe, and then that way you don't have to do that all over again. My name, of course, is Joel Garris. With me this week is Zach Keister. We're certified financial fiduciaries with Nelson Financial Planning, where we got a team of great people beyond just Zach and myself who are privileged to work at, according to Orlando Business Journal, one of the best places to work here in Central Florida. So feel free to give us a call and schedule an absolutely free conversation to see how we can help you. So the issue of these private equities, let's sort of set the stage a little bit about what exactly is a private equity investment, Zach.
So it's, a non-public company. So private equity, non-public company. So think of like your Facebooks back when they were in the dorm room or that sort of stuff, or Bill Gates with Microsoft when he was still in the garage, or Apple, Steve Jobs with Apple in the garage, that sort of stuff. That's odd how they all started in garages, didn't they? Either door rooms or garages. So there you go.
I need to maybe make some room in my garage for my kids to go do something.
So it's finding those kinds of companies before they become public and investing in them. Kind of a very needle in the haystack scenario.
Sure. Well, and it sounds alluring, right? Wouldn't it be great? Wouldn't it have been great to be in the dorm room at Harvard next to Mark Zuckerberg and be one of those first people? Imagine how much money you would have had you been in that dorm room and gotten involved in Facebook at the ground level. And that's the allure of these private equities.
Sure. Yeah, it's painting the picture of, imagine if this were to happen, if you could be involved in the situation. And it gets kind of emotional as well.
Sure, because, hey, who wouldn't want that? And so that's basically kind of what private equity is all about. Where literally you're looking for, Zach, as you said, kind of that needle in the haystack, that company that is not publicly traded, but it is just starting out, and who knows, it might be the next Microsoft or Facebook or what have you. And I guess that underscores one of the key limitations to this, because if it is private, that means there's no public market.
Correct. Yeah.
And that means there's no good way to sell those shares because there's not a market for it.
Correct, yeah.
Hence the private equity part of it. And the big players in that industry, would be KKR, Carlyle Group, Bain Capital, which is, I think people know that name because it was where Mitt Romney worked for many years. And so that's kind of the background of owning it. But there's a couple of issues that are sort of unique in today's world that have changed a lot in terms of the dynamics of how these private equity investments work.
Yeah, definitely. That's for sure.
So the higher interest rates that have really come and involve these private equities, because there's a lot of borrowed money when you do that, right? So when you're doing a private equity investment, you are ultimately borrowing money, and as those interest rates go up, then that helps to reduce down your return. It also, these management fees, oftentimes 30 or 40%, and a relatively tough problem for some of these pension plans that have really loaded up on these private equities.
Yeah, when you couple all those together between the interest rates, the illiquidity, again, the facts of how far they're having to go to then pay out on the pensions,
right.
It's just one stacked on top of the other, creating the snowball of issue.
Right, because if you think about California CalPERS, which is the country's largest pension plan for now 8 years in a row, has had to pay out on these private equity investments rather than receive money. So that becomes a losing proposition. And if we look specifically at the FRS, and again, we're not going to try and bash the Florida retirement system, but Florida retirement system, Zach, has about $200 billion under management, and roughly about 9% of that is in this private equity. Another 11% is actually in alternative investments as well, or what they like to refer to as strategic investments. So that's a lot of money that is tied up in this private equity side.
Yeah, it's definitely not a small share, that's for sure.
That is absolutely. So one of the things that when we look at that, it really has been a bit of an underperformance. So if you think about the Florida retirement system pension plan, $200 billion in there, 9% in private equity, it's about $20 billion, give or take. The underperformance just in the past 12 months has been 20%. That's a lot of money.
It's a lot of money. It's definitely a lot of money.
$4 billion.
$4 billion is
right.
the quick head math on that.
Yeah, exactly. $4 billion of so it's one of those things that, and look, this is what's happening for large, sophisticated institutional investments. And that's sort of the appeal of, if I'm the state of Florida pension or another pension plan, I can just sit and because I've got a huge amount of money and I can let this money just sit and ultimately have it pay off. Well, private equity is certainly not paying off. The tough part is, and Zach, you know the statistic, it's really starting to proliferate to individuals as well.
That's a 17% we were talking about. 17% of individuals are their portfolio is invested in this stuff. So.
No, it's starting to get much broader, and I think what it comes down to is, it's one of those fundamental concepts that we talk about on the program where you've really got to know what you own at the end of the day. And Zach, one of the things you do at the office is kind of run these reports that help us understand and know what people own.
Yeah, they break down exactly the companies that they own, even into the sectors, various different sectors, companies themselves, risk levels, what have you. And it's a great program that we utilize frequently on a daily basis almost. Yeah.
Well, and it's a great way to really see what's happening inside. So it's so important to sort of know what you own, because if you're starting to own, and pensions are certainly, I think, perhaps waking up to, wait a minute, this is not as good of a deal as what we thought it might have been. But unfortunately, that means that that these dollars are kind of shifting where, okay, if the pensions are wising up to this, then we're going to, now try and push it off on individual investors. And I think that's where, you think about illiquidity, not able to get out from under it. Those are some significant limitations.
Yeah, they certainly are. To serve specifically your retirees an illiquid investment, I mean, there's a lot to be said about that.
Because what happens with that illiquidity is then if you do want to convert it to cash, some pensions are even having to borrow money, because if you did convert a private equity investment to cash, more often than not, it trades at about 20% of value.
Yeah. So you're losing on that point as well. I mean, they're having to borrow the money, and obviously the interest rates are a little bit higher right now. So it's a double kind of loss there.
So even though it might sound really sexy to have been in that dorm room at Harvard when next to the inception of Facebook, the reality is that that's really a needle in the haystack. There's some high costs, some illiquidity that you need to be aware of. Certainly pensions should know better, but they don't. But as an individual, you can certainly control that on your individual portfolio. So really take the time to know and understand exactly what this is and what's going on. So if somebody starts talking about private equity, strategic investments, alternative investments, your radar really should be going up to stay clear of the limitations that happen in those types of investments. With that, we're going to take a break and continue here on Dollars and Cents with Joel Garris and Zach Keister of Nelson Financial Planning. So just how important is it when you're trying to retire, planning for retirement, to start as early as possible. Well, this next segment is all about that and really gives you some specific numbers to be thinking about that you really need to pay attention to. So, Zach, tell us a little bit more about what we're going to be talking about in this segment of the program.
So we're going to be talking about procrastination, how much it costs you to procrastinate when it comes to investing for retirement.
Right. Yeah, procrastination always costs, but in particular, it can be quite dearly if you're planning for retirement.
Quite dearly. We're going to share a ton of different facts, a lot of numbers in this as well.
Yeah. So go ahead. So we got a couple of different investors that's in this example, and I think this was something that is in the book, Next Gen Dollars and Cents, which of course is available on Amazon, or if you come into the office for one of our free consultations, I bet you Carolyn and Jamie will give you a free copy anyway. But this was a part of the book that you really worked on to kind of put this analysis together for us.
Yeah, and the analysis is pretty staggering when you look at the breakdown of numbers. Again, like Joel mentioned, this is in the book, page 122. It's chapter 13, how the individual investor does on a DIY basis is the breakdown of that. And those of you that are joining us on YouTube, here's a good printout. And those of you that join us regularly on radio, maybe this will give you a shot to pull up the YouTube video and give that a go for once. So we're going to take a look.
Or check out the book.
Right.
I
mean, two options, YouTube or the book. So we're going to look at two different investors here. One age 22, investor A, age 22, investor B, age 32. So investor A invests $3,000 for only 10 years. That's key. That's very important. Only 10 years. And investor B invests $3,000 annually for 34 years.
Because he starts 10 years later.
And Joel, who do you think wins?
Well, I've been doing this a long time, so I know who wins. The guy that starts earlier.
The guy that starts earlier.
Not just a little bit. He wins by a lot.
66% more he wins. And he goes for 10 years versus the other guy that goes for 34 years. I mean, that's absolutely staggering.
The numbers really are just fascinating. And this is a piece, Zach, that we've been using at the office for 25 years. It used to be, I'll tell you the age of how far back this piece goes. So we used to run this with $2,000 because that was the maximum contribution that you could put into an IRA. So we used to connect it back to $2,000 being the maximum amount you could put inside the IRA. Obviously, I think it's like $8,000 if you're over 50.
Yeah. $7,000 if you're under 50. So
it has changed a little bit, but the numbers still bear out. Even a little bit of money. So in this example, it's $3,000. Investor A starts at 22, goes for 10 years, and then stops. By the time he reaches age 65, he has 66% more than the person that waited 10 years. Finally got started, so that's good that they got started, but then ultimately still, even though they invest almost 3 times what the person who started 10 years earlier, they wind up with significantly less money. Pretty amazing.
66% less.
Yeah, 60. Yeah, it's pretty sick. And that really gets back to the power of compounding, right? And you were saying it's
our friend Albert Einstein's 8th wonder of the world, compounding interest.
It certainly does have a powerful impact, and that's why important to get started early, because ultimately then you have that power of compounding working for you, and it plays out particularly well when we think about investments. It's funny, and so one of the things that that we do at the office course is we try and market through social media, Facebook, and all of those places, and so we actually had this posted on Facebook, so you can check it out on Facebook as well. And we thought, maybe we should boost it, because that's kind of how
it works. How the ads work.
Yeah, that's kind of how Facebook that's Facebook's business model. When you boost stuff, you have to pay for it, and that's advertising. And so we said, this is pretty neat. We're gonna boost this, and we got rejected.
They did not agree with Albert, I guess.
Facebook robots didn't understand the power of compounding, and so the post was rejected. And I got to get this in front of me because it's just such a classic. Okay, where did it go? It was rejected. Here it is. It rejected because it doesn't comply with our unrealistic outcomes policy. How's that?
I guess I guess the bots of Facebook have an understanding how investment works. I don't know. That's something.
They do not comprehend the power of time and the power of compounding, because it really is just dramatic when you start to think about that. Waiting to invest is certainly going to have some pretty adverse consequences.
Yeah, absolutely. Tons of adverse consequences, and we get it. There's usually two main options when it comes to I can't invest right now. It comes down to two things: I can never seem to find the money, or I just don't know what I'm doing. I don't know where to start. I don't know how to get in. And we would tell you, come have a conversation because we can answer both of those questions with you.
That is very true. And it comes back to a fundamental thing that we were talking about earlier in terms of budgeting, right?
Yeah, absolutely. Yeah, highly important.
So if you're budgeting, then ultimately you're able to perhaps look for those ways to find that little bit of money that you can put in on a monthly basis.
Yeah, anything helps, absolutely. And as we shared within Investor A and Investor B, delaying costs.
Right. No, absolutely. Well, but it certainly is tough now, and that's why I think it comes back to budgeting. The impact of inflation on many Americans, and really all Americans, has been pretty dramatic, and so it's important to come back to that concept of budgeting to be able to make sure that you're using that as a tool to help find that money so that you can, in fact, get started on saving for retirement. So certainly raises a lot of good questions in terms of, okay, well, how do you ultimately wind up taking advantage of that concept? Because when we talk about putting money in on a regular basis, it really is, in this example, it's $3,000 a year. So that means that you're putting in a little bit of money each and every month to ultimately get that contribution in on a regular basis, and then ultimately use the power of time to really help improve your retirement picture. Now, the good news is that better to start, okay? Even if you're starting late, certainly better to start. And that comes back to the importance of trying to budget and really dive into where you can save some money and ultimately put that towards investing.
Yeah, absolutely.
So if you need help with budgeting or those kinds of decisions, we would once again refer you to our book, Next Gen Dollars and Cents, available through our website, available through Amazon as well. All of this analysis is in the book.
It is.
And you even had the page number.
122, yeah, page 122.
122 of the book, Next Gen Dollars and Cents. So you make sure you check that out as well. And we certainly appreciate you checking out the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. In addition to that, one of the top 25 financial planning podcasts as well. So make sure you check us out on your favorite podcast platform. Once you find us, make sure you subscribe, and then you don't have to find us again. We'll automatically be connected. My name, of course, is Joel Garris. With me this week on this week's episode of Dollars and Cents is Zach Keister, fellow certified financial fiduciary, on his inaugural radio program. So we're excited to have him join us on the program this week. We're going to take a break. When we come back, we're going to talk a little bit more about private equity, its role, or what its role shouldn't be when it comes to your investments, along with just sort of wrapping up this conversation of why procrastination really costs and how you can use the power of time and compounding to have that work for you when it comes to saving for retirement. So we're going to take a break. We'll return after these messages here on Dollars and Cents with Joel Garris and Zach Keister of Nelson Financial Planning. So that's pretty interesting. We were talking about in the last segment about Facebook, Zach, rejecting our advertisement that highlights the cost of procrastination.
Yeah, trying to beat the bots these days. I guess humans haven't stopped ruling as of yet.
Well, that is very true, but apparently a robot does not appreciate or understand the power of compounding, because that stinky power of compounding apparently in Facebook's mind produces unrealistic outcomes.
Mm-hmm. Yeah, and absolutely. We're happy to share the realistic outcomes with anybody, or for that matter, any AI chatbot that would like to know about it.
Certainly the analysis that we do, and we have it inside the book, as you've said, it's on page 122, is something that you worked on quite a bit as we were putting the book together last year. It really does help to sort of underscore the power of compounding. It uses a very, kind of a baseline rate that we just simply apply to the numbers, and you really do see how much you can have money grow over time using that power of compounding. And sure, it looks certainly unrealistic in terms of the outcome, but the reality is that that's just kind of how the math works.
Yeah, I mean, you can't beat the math. So
that's exactly right. So make sure you check that out. It certainly does underscore a little bit of that power of compounding and having that over time as well. Now, Zach, earlier in the program, we were talking about the ability of that person who waits versus the person who starts early. We get it. There's a lot to spend money on. Mm-hmm. We've got, best way to kind of really get to do that is to look for ways to try and save money so that you can add it into an investment account.
Yeah, absolutely. I mean, we totally understand the rates are higher. Groceries, every time I go to the grocery store, it hurts a little bit more, and that's kind of how things are nowadays, especially when you have to, you have to get a new car or what have you. The rates are really hurting.
Right. Well, and that's where the concept of budgeting really comes into play.
Yeah, highly, highly important, and just to try and find that little piece in there, even if it's $25.
Right.
$25, $50, whatever you can do on a monthly basis just to get started, particularly while you're still young. That compound interest can help out along the way.
Yeah, all comes back to the power of compounding. That it turns into much more if you have that time on your side. And so I think that really comes down to sort of some key takeaways that people need to be thinking about when they think about how do I ultimately use this power of compounding to my advantage. And
Yep. Go ahead.
No, and so one of the ways, of course, is through budgeting and trying to find that as well.
Yeah, just have to stick to a budget, come up with a budget, and stick to it on a monthly basis. Again, try and find that couple of dollars if you can, and look at it. Might be helpful to you to look at page 122 of the book on a monthly basis and say, do I really need to go out to Starbucks, or could that $25 I spend on Starbucks go into this account? Maybe print it out and put it on the fridge.
Yeah, that's exactly right, and that's what budgeting is all about, is really keeping track of those expenses along the way. And I think it also dovetails into the other thing that we're talking about on the program this week, which is the concept of what do I actually own, and that's such a key takeaway. When we talk about what some of the available options are out there that have really started to proliferate across not just inside pensions, but also inside investor portfolios.
Yeah, and we talk about it heavily because it's such an issue when you look at the illiquidity of this type of investment. And a lot of folks, again, back to your comment on know what you own, a lot of folks don't know what they own and they have no idea what this is. They're trusting an advisor to just put them in the best spot possible.
Well, and I think, as with anything, it's all about kind of what sounds good and the appeal. And, if you're being told, oh, well, this type of private equity or alternative investment, you could own, the next Facebook, or you could own the next Microsoft or the next NVIDIA before it ever becomes a public company. And that's fine, but that's a pretty limited chance of that actually happening.
Yeah, it's very much a needle in the haystack. And again, that's another one of those things. Investing is highly emotional. We get it. It's very, very emotional. So when you paint this picture, this magical picture like you were talking about earlier, you could be, investing in the company right there with Mark Zuckerberg at Harvard in the dorm room, and you start to paint this beautiful picture and your mind starts going, you might want to step back and take a look and say, what actually is this? What am I actually putting my money in, and how is it going to play for me?
Yeah, certainly significant limitations when we talk about alternative investments, particularly this category of private equity. And the trend is pretty disturbing. And I'll give you those numbers from just the state of Florida's pension plan. $200 billion under management. They've got about 9% in this private equity stuff. So it's about $20 billion. If you look at what they've done over the past 12 months, as of March of this year, there's been a 20% underperformance. Mm-hmm. 20% on $20 billion is
four.
Yeah. That's a big number when it comes to making sure that the pension plan that's paying out all these retirees their monthly check is in fact in good shape. If you think that's bad, as you might well imagine, the financial condition of the California pension is even worse. They've got 8 years
in a row
where they've had to pay out money for these private equity investments. So, and the sad thing is it's starting to proliferate into the individual investor as well. Mm-hmm. So important to really take the time and understand and know what it is that you own.
Absolutely. And then just to state that fact again, 17% on an individual investor basis, 17% of portfolios are put into private equity.
Well, and you certainly see it regularly at the office, because one of the things that you do is when folks come in for the first time, we ask for a complete copy of their statement, not just kind of a summary, but a complete copy. And then we take that, or you take that, and you run it through the Morningstar software.
Mm-hmm. And then that kind of dovetails back again, Joel, knowing what you own. That's why we request the full statement. Right. We want to know what you own, and we want to help you understand what you own.
Right.
That's another aspect that's very, very important. We want to help you sit together and go, okay, here's the different funds that you own. Here's the sectors that they're in. Here's the types of companies that you own. And so you can have a greater understanding.
Well, and to that point about how much of these alternative investments, private equity stuff is starting to show up in individual investor portfolios, we see that oftentimes as we're doing these analysis. Mm-hmm. And the reality is that they are highly illiquid, and to the extent that you do want to sell them before they sort of become public, which is sort of the liquidity event that happens with these private equity investments, more often than not, you're going to sell them at a pretty steep discount.
Absolutely. I mean, and that's, again, the snowball effect. And it's just this ridiculous mismatch between folks that are relying on their pension to send them monthly income and the illiquidity of private equity, and then the routes in which they have to take to then get you your monthly income.
Especially in today's environment where it's higher interest rates, which obviously changes the dynamic and the profitability of private equity. But so we will, I'm sure, continue to talk more about this topic in the future, because we don't believe it's going away, especially when 9% of the state pension plan is sitting in private equity, and then another 11% is sitting in strategic investments. That's almost a fifth between those two categories.
Yeah, absolutely. And not to pick on FRS individually. There's tons of pensions out there. Sure. And like we shared, the 17% on the individual side, this is, kind of popping up everywhere.
Right. No, it really is. And it goes back to some of the fundamentals. And that's what we're all about on this program, is just talking about the fundamentals, talking about the fundamentals of investing. It may not sound as sexy as being in the dorm next to Mark when he starts out Facebook, but at the end of the day, fundamentals always win out. And so certainly we underscored that, Zach, on today's program by talking about the power of compounding, the power of time in versus timing, all of those so important concepts when it comes to your money. So what do you think, Zach? Did you enjoy the program?
I thoroughly enjoyed it. Happy to get behind the mic again. Been several years, and yeah. It's a fun time. Very fun.
Good. Glad you were able to join us, and glad you were able to join us as well. Thanks for listening to this week's program. This has been Dollars and Cents with Joel Garris and Zach Keister of Nelson Financial Planning.